What a day, what a week, what a month. Today was as epically crazy and volatile intraday as Friday was the other way. I am so relieved, as is everybody here at the Context Summit, to have the result that we had today, which really, look, we are in what I call the triple threat of someone who really loves alliteration of, rapidly rising rates. And the market has been working overtime, as has all of the algorithms, to try to figure out what that means and what that pace means for valuations and global equities. I think that today, is there capitulation? Is there a bottom? Look, I don't think there's... All eyes are going to be on that. We have over a third... Yes, please.
No, sorry, we were losing your connection there a little bit.
Sorry
Alli.
about that.
So finish your thought. I think it's back.
Yeah. So look, we have a third of the S&P reporting. IBM's just about to come out. We have a lot of the mega caps. We're expecting large scale beats. We're expecting a 12% year over year earnings growth. I think that is finally going to start to be the story now that we have this behind us. But volatility is here to stay. Make it your friend. Buy in, establish long-term positions, get defensive with healthcare, and stay in the game. This is normal.
Mike Santoli, CNBC's Robert Hum, just sending us all an email saying that this is the first time the Nasdaq comp has shown this level of turnaround from 4% down intraday to close positive since November the 13th, 2008, which of course does not bode particularly well, given that markets didn't bottom for another 3 or 4 months after that.
Right. Now, the textbook says that the most violent short-term rallies do happen in bear markets. I don't think we can draw conclusions from a precedent of two at this point, only one of which we know the result of. I think we could look at today's activity in the early part of the day and say it's totally plausible. We got a pretty good purge, things people have been waiting for, and on a near-term basis, it could use as like a mental marker for the lows for now. It's not going to go down in a straight line, even if we're in a bearish tape. I still think it makes a lot of sense. Very squeezed type activity into the close today, but that's okay. As I said, it all starts with short covering when you have one of these intense sell-offs. So tactically, you would expect there to be a lot of back and forth action. That would be another thing the textbook would say. It wouldn't necessarily be a V back to the highs, even in the best case scenarios. But, it looks like it was pretty constructive today. People are going to look at those charts and say, this looked like the market made a little bit of a short-term stand. And then I think if you're an investor, if you're not in the business of looking for things to buy at a better risk-reward bargain, when the market goes down 10% in 3 weeks, then you're kind of not in the right game.
But, Alli, it doesn't change the fact that we're still in this environment where we're seeing the highest inflation rate since the early 80s, an economy that is doing well but is losing some momentum, and a Fed that is getting more itchy to tighten policy, raise rates, potentially tighten on the balance sheet. So with those risks out there and the constant, is the Fed behind the curve? Are they going to make a policy mistake? All of that noise in this environment, what I know you still like stocks. What part of the markets do you go, given we're still facing all of the same risks that we were before this recovery today?
Yeah, I think that's a very important point. And all of this comes to one concept, which is for the last decade, the market has been able to count on the Fed to support growth. They are now likely going to be swinging the pendulum and have a very different perspective and acts to take care of. And the market is figuring out how to interpret what that means for valuations. What that means is, yes, we still think that there's going to be growth. Yes, we're still leaning in, especially to the first half, into cyclicality. But you need to add a little bit of defensiveness. You're still searching for yield. So whether that's in stable dividend payers or whether you're getting into senior loans, that's really important. And even if you're getting into tech, think about the least growthy tech. Think about the things that are exciting, revenue producing disruptors and that have, a long. But this is a really important concept. And this meeting is going to be really important because the narrative that the Fed has been there for a decade with a singular perspective, which is to support consumer and corporate growth and spending, that may be changing. And so both the volatility and this re-rating, this reset, they are real.